Okay, so let me welcome you to today's edition of our class on how to invest in shares and stocks. So this is week 3. I know it's going to be um, becoming more technical as we go deeper into each of the weeks. So today, we are going to be talking about understanding dividend and then how to diversify or grow your portfolio. So how do we identify, what do we have, understanding do we have about dividends? Actually, in our previous classes, I have actually spoken about dividends lightly. So, but today I'm going to be going deeper into the discussion about dividends and then how you um, grow your portfolio. Then I'm going to be using practical example from what we experienced in the market last week. So market was bearish last week. That is, it was on a downtrending. So that was why I said what you need to also know in a downtrending situation. So I will be sharing that with us as well, what we exactly need to do when the market is downtrending. But basically, I want us to have a good understanding of dividend and what it could do in how what it could do as a means to grow your portfolio. So now let's start by doing a small recap of the week 1 and week 2. And like I said, the session is going to be more technical now, and it will now be more engaging. So it will now be more engaging, which implies that we will be needing you to concentrate more and then interact more with us so that it will not just be a session of meeting and leaving without having a significant impact on our growth. And what type of growth are we talking about? Financial growth. So that's what I would be pleading to us today, that we should please make it interactive, and at the same time, let's make it engaging. Let's make it interactive and let's make it engaging. So the topic we'll be discussing today once again is understanding dividend and portfolio growth. Then what do you do when the market is coming down? So if you look at the trend that shows on this left hand today, we have a downward market trend throughout last week. I think from Tuesday downward, the stock market was relatively on a downtone, and that is not a worry. We don't need to be worried about it. So today I will be sharing with us what to do when the market is turning downward. And then this guide that I'll be sharing with us is this PowerPoint is a guide that would um, give you some kind of first knowledge understanding of what exactly you do with your dividends when you are getting your dividend. Because many of us, we get dividend and immediately we pay it into bank and we spend it. I'm one of them anyway. I remember when Stanbic IBTC sends me their dividends, it goes into my normal current account. And at a point, I begin to feel like when I will even spend it, I may not even remember that, oh, so I've even spent these dividends. So what do you do with your dividends? Are you supposed to spend it immediately? I want to even know, do we really understand what a dividend is? Then I want to also discuss how we can use our dividends to grow our portfolio. And that is exactly what I did on my other trading platform. That's my shares and stock trading platform, whereby I ask them to keep reinvesting my shares into my ISA account. So with that, it continues to grow my wealth. And in view of that, I I have a kind of a balanced portfolio, so to say. So let me start this presentation so that I can go straight into the class. So now, before I move straight into today's session, I would like us to do some recapping. So, is anybody ready to tell us, share his or her experience, his or her trading experience with us? Has anybody started doing anything? Then do we have our winner of our capital? So let me see if we have anyone that wants to share his experience with us. How is the trading market going? Then what will you like us to know? Blah, blah, blah. Anybody? Is anyone making some attempt to do some magic on their platform? Okay. If anyone is willing to volunteer to speak, then you can unmute yourself in case you are talking. Then, then if anyone is not talking, then it means we have all not started to invest. Yes, I know that investing it's a sacrifice. It involves how do I put it? It involves setting aside extra capital. Is going to likely affect your present spending pattern. So I know it's not something very convenient for everybody to do, but it's something that everyone in this class, most importantly, must do. Is a must do for all the members of this class, because that is what we show that the time we are investing into it is not really a waste. So that has been said. Let me move on into this class fully. So I said we're going to be talking about dividend fundamental. We're going to be talking about portfolio growth strategy. How do you grow your portfolio? And then we're also going to look at discipline while you are building your wealth. I have put it in this presentation, what happened in the market this week. I will show us some things that I have on my own trading platform. And it will be a very good example to us to understand that sometimes you lose some money, sometimes you gain some money, but in the long run, you keep gaining in the market. That is what stock is all about. Because if you invest in the shares of Dangote, for example, today, you cannot continually have a going up trending shares of Dangote, but sometimes it's a wave. It goes up, it comes down, and I've explained to us last week what causes these waves. Is a forces of demand and supply. It is a fundamental issues like news and occurrence in the economy, and it also has to do with technical pattern of how the stock is moving, because there are some people that watches that technical movement to make their decision. So, and their decision determine the market and the supply and demand of that particular stock. So, I put it that we are also going to look at that today. That is looking at how the market is moving. So, moving on. The next slide is yes. So this presentation or this session, basically, like we discussed last week, is being put together by FinREMIT as part of our FinPowered initiative, that is Financial Empowerment Initiative for Migrants in the Diaspora. And what we are trying to do is we're looking at how we can create a financially empowered people both at home and in the diaspora. We also want to see how those at home are not living within the limit of their salary or present income, but rather begin to diversify. And at the same time, how we can begin to have multiple streams of income, how we can have multiple streams of income from shares and stock. So as it is on the screen, if you have not downloaded the FinRemit app, we would wish that you download the app on Android. And if you are not following the pages, you can follow us on FinRemit and Instagram as it's showing on the screen. So you can follow us to see updates as regards what we are doing, and that is a little way for you to support us with what we're doing. If you are on a TikTok live, you can also share the session with your friends and family to see what they can do to earn some more income. So now let's go straight into today's class. Let's go straight into today's class. So the outcome of this class is to actually prepare us for some bigger announcement that is coming ahead. Because like I said, we are building an investor community. So I want you to first have a good understanding of how the global stock market is operating. Because by the time FinRemit is taking you to another realm of you now becoming a big investor in Nigeria and your investment is now looking for shares, you already understand how these dynamics work. So that is one of the reasons why we're doing what we're doing now. The other thing is for those in Nigeria and you are planning to start a business or you are doing a business, by the time FinRemit is matching you with investors that will be putting money into your business, you will begin to understand that, oh, so this is how it works. And for some of us as well, when we are planning our pensions or retirement, we can also begin to look at it and say, oh, so I don't need to, when I retire, I don't need to be struggling, running up and down. I can just put my money into an existing business and I continue to make more income rather than just using old age to struggle up and down. At 70, 80, we are still wishing to earn salary. That will not be too good. But with understanding of stocks and shares, you will be able to invest in whether global stocks or local stocks or even upcoming companies. So, and those are the end point of where we are going. And by the time we will be getting there, I'm not going to be announcing to many because at that point, we will not be too many anymore. So those are the people that I will know that, yes, these are the set of people we need to work with to get this project going, because it's not a small project, but we need serious people that would be going along with us. So the end point of these classes is actually not just about um, it's not just about investing in the shares of Coca-Cola, whatever, but it's also about investing in a bigger form that would make your money begin to earn good income for you. And because now the shares that we are buying in these companies that we are investing in, they are not very significant. We can saw it in last week classes, in last class, two classes, that some of the shares we bought is like 0.0 something percentage of the whole shares. Imagine me, if I need to buy shares that is worth 5% ownership of Tesla or 5% ownership of Coca-Cola, I know I need to go and raise millions of pounds, as the case may be, because these companies are worth trillion. So if I want to buy 1% of 1 trillion, I need to be looking for about billion or billions of pounds to invest in 1% of Tesla's shares. But who says you can also not have a business that will be valued that high anytime soon? And that is the reason why we're doing what we're doing now. So as you are buying 1% of shares in Tesla, 1% of shares in Coca-Cola, 1% of shares in MTN, then you will begin to now have that mind like, wow, I saw this business. I can buy 50%, I can buy 30% of shares in Amugold. And then you can talk to the owner of Amugold and say, Amugold, I need to buy 10% of your shares. And how much can I pay to own 10% ownership in Amugold? That is the mindset that I'm creating for us. How much can I pay to own 10% of shares in a growing company in Ilorin? maybe, for example, there is a company called EasyMex, for example. So some of you can feel like, oh, EasyMex, I love this idea. I want to invest into it. How much can I give you to take 10% ownership of this company? And the founder of EasyMex can just say, oh, give me 10 million naira and I'll give you 5%, or give me 20 million naira, I give you 10%, because you need to have an understanding of how investment works. But for someone that has gone through this class, it will not be new to you anymore. Then you can also have a good understanding of dividends. When EasyMex or Amugold or any business you are invested in is now bringing returns and they are sharing dividend, it won't be strange to you anymore, and it will not cause argument between yourself and the investors in your business or the business that you have invested in. So I want us to please pay serious attention to this, because the end point of this class goes beyond what I'm teaching us. Now, dividend. Like I said, it will not be too impressive if questions are not being answered. So I would appreciate if we can make this class interactive. I will really, really appreciate it. So whether right or wrong answer, don't bother. It is not, there is no right or wrong answer to this. If we know it all, we won't be in this class. So if we know it all or we know it well, then obviously we will not have to be in this class. So when I ask questions, I want us to interact. For those that can talk where you are, it will really help me to know whether we are really following, or I need to either slow down a bit in my speed, or maybe I need to use a lesser technical words to make it more understanding to us. So what do we understand by dividend in our own words? I've left this screen for a while, so I will try and slide away from the screen now. So what do we understand by dividends? If you want to say something, you can raise your hand. From all the classes that I've done, the screens that I've shared in the last two classes, thank you so much, Mr. Alaide. So you have the floor now, you can unmute. So what is dividend? For those online, you can put it on the chat, and anyone too can drop their own understanding on the chat. Don't do ChatGPT. Do what you understand. Go ahead, Mr. Lide. You can unmute now.
All right, thank you very much. Good evening. Thank you, everyone. So, my understanding about dividend is the extra benefit that I receive if I invest in MTN Nigeria, for instance, after a year cycle, and that can come in form of additional share, maybe like one for every 10 shareholding. Then it can also be in a profit share
Okay.
to me as a shareholder in MTN Nigeria. That's my understanding. So basically, extra benefits I
Okay.
receive as a result of
Your
being a
investment.
subscriber in a company share.
Okay. Yeah, you've actually nailed it, but you missed some things together, which is a very good one that you have been able to say now, and I will make clarification to that. And that is about the extra benefit. Yes, dividend is an extra benefit, but when you mention that part of maybe extra shares that they give you, then extra share is not a dividend. So in finance, technically, being given an extra share is another benefit, such as getting dividend is another benefit. So getting extra share is called bonus issue. So it's called bonus issue, which is a benefit for you being a shareholder. So some companies can say, oh, we want to issue more shares, but those that has shares with us before, we will give them some bonus. They will give them extra share. Like there was a time I received a mail from Stanbic IBTC that so company can say for every 1,000 shares you have in our company, we will give you 10 bonus. So that extra shares of 10 is because you have 1,000. So if you have 2,000, your shares will now turn to 2,020. That is bonus issue. However, dividend is also a benefit, but it is not about collecting extra share. It is the profit of the company that is being shared, your own portion of it, according to your shares holding in that company, is your dividend. Let me see. I think someone is trying to put something on the chat. Mr. Taye, you will be my anchor for today. Um, if you can help me pop up some of these. Okay, let me see, because they may have to be questions. Okay, thanks for the clarification. So that's that from Mr. Lide, but I'm happy that you are able to put your words in. Do we have any other person that wants to share their understanding of dividend? But I think that is straightforward anyway, so let me not waste time on it. I would call for another question anytime soon. So okay, Mrs. Omolara, you are over to you, ma. You can go ahead, ma. Mrs. Alago,
Well, good evening, everyone.
good evening, ma.
I think dividend in a layman's language means profit to
Profit
me.
sharing. Brilliant. So thank you so much. That's a very straightforward one as well. Dividend is just your share of the company's profit. Your share of the company's profit. However, some companies can make their own dividend be in form of, there are different type of dividends, which is also going to help in my discussion going further. There is the cash dividend, and there is also shares dividend, like Mr. Lide said. So now let's move on to how dividend can drive your portfolio. How can dividend drive your portfolio growth? So now let's see this page. It says the true power of dividend lies not merely in the income they provide, but in their ability to fuel exponential growth through reinvestment, even period when shares price is coming down. Like I said earlier, the share price of a company can come down. Okay, now before I go deep into this, there is a statement I would like to make. The profit that we are talking about sharing, the profit that we're talking about sharing is actually not the whole profit of the company. The company always declare a part of their profit to be shared as dividend. So the company will come and say, this year we have made 10 million naira as profits. And profit, we all understand, is after you have removed all expenses from your income. That's your sales, your revenue. So when you earn your revenue, you remove your direct cost, then you have your gross profit, and then you remove all your administrative and operational expenses that are non-direct, and you have your net profit. After that, you remove the company tax, which is what you pay to the government. We are also going to be having another session for that, which is after we end this investor class. That will be on Saturdays. And when we are talking about that, we're talking about those that already have a business or those that want to start a business. So this one is for investors, people that want to invest in the company of another person. So, and then in some other classes by January, we are going to be doing matchmaking of people that wants to invest in other people's business and businesses that also want people to invest in their business. So at that time, we will be asking you to come and pitch. So you pitch your business to us at FinREMIT, where we have pool of investors sitting down to listen to you. And you also tell us how much of those you want the investors to invest in. But if you don't know all of these terminologies, when you get to the investors pitching session, you may be turned down. I recently watched a video of a business an entrepreneur seeking for funding, and this entrepreneur is giving loan to students. He's a Nigerian business and he's pitching to investors. So he's giving loan to students, and one of the investors asks a simple question: what is your net earnings? And then he now asks again, what is your WACC? We said, what is your WACC? And in finance, WACC is WACC. But if you are into business and you are looking for money outside of your initial money that you use yourself, and you don't know some of these financial terminologies, you may be losing a lot of opportunity. WACC, the full meaning of WACC is weighted average cost of capital, and they are asking him, how much, what is your WACC? And then what is the rate at which you are giving student loan? So he answered and said he gives loan to student at 30%. Then they ask again, is it 30% per annum or 30% per month? Because loan can be given out per month or per annum. And he said he gives out 30%. And they asked, if I get a loan of 90 days, I'm going to pay 30%. He said yes. If I get a loan of 30 days, I'm going to pay 30%. He said yes. At that point, they know that he is only giving out loan, but he doesn't understand his operational process. The second thing that they asked him that was very critical was that he couldn't answer his WACC. And WACC is that all the money is taken from people that invested in his own business so that he can use that money as loan to students. There are some returns that is going to pay back to them. So if he's going to pay them 10% per annum and is getting 30% per annum from the student that is borrowing those money to, then his WACC, his weighted average cost of capital is 10%. His average percentage of return on investment is 30%. So his spread is 20%. So he couldn't answer some of these questions. So I want to challenge us. By the time we get to that session where we will be talking about people that are running a business in Nigeria, that are looking for investors outside of Nigeria or even within Nigeria, because by that time, some of us in this class, we want to migrate. You will receive a mail where you want to belong. Some of us may say that, yes, I want to invest in businesses. I will class you aside. Some will say, I have a business and I'm looking for investor who will class you aside. Then we'll now create a session where you guys can talk and pitch to each other. And it's going to be done remotely like this. And then we now move to the next stage, on and on and on. Then we hand it over to those that will do the management of the wealth. This is like trying to demonstrate exchange trade fund that we discussed last week, ETF, and real estate investment trust that we also mentioned last week, but we can do it informally as well. So now, dividend is the profit that the company has shared after they have declared it and they have approved it at the annual general meeting. So a company will announce and say, we have made 10 billion this year. We are going to be sharing 2 billion of it to our investors. The remaining 8 billion, we want to give 2 billion of it as additional bonus issue. Like Mr. Lide explained as well. Then the remaining 50 billion, we want to make it as plowback profit. That is, we don't want to share 50 billion of our return. We want to put it back into the business so that the business can continue to grow. So that 10 billion that they want to share, that is the dividend that has been declared for sharing for that year. So it is that dividend they will now calculate EPS, that is earnings per shares. That's the dividend that you are going to be getting per share. So if you have one share and the company says they are giving out 50 naira per shares as dividend per share, that means they will give you 50 naira. If you have 100 share, they will give you 5,000 naira. If you have 1,000 share, they will give you 50 times 1,000, which is 50,000 naira. And that is how it continues like that, based on the numbers of shares you bought from the company then. This is just a simple analysis to you to understand how dividends is being calculated. So in this note, I put it here, I said, when you have a dividend, especially in this era of digital investment platforms, when you have a dividend, try to reinvest it back. The reason why we are doing all of these investments we are doing today is really not to say we want to get that money immediately. Because take, for example, we put 5,000 into it. After we put 5,000 into it, some of us put 500 pounds, some of us 200 pounds to start doing some savings and trading as well, whereby I said it in the first class that the money you are putting into your savings, that we are just trying to make it work for you. That's why we are looking at save then invest as well. So those money, some of them are not really significant to even meet your present need. So we are trying to keep it there for future growth. We're trying to keep it there for future growth so that we can say, oh, I started with 5,000 naira, it's now 10,000, it's now 15. So for now, I don't advise us to start thinking about spending our dividend. So, and it says here that unless you require immediate cash flow for living expenses, always reinvest your dividend through what is called drip program. So it is advisable to reinvest your dividend. So dividend reinvestment makes you to continually grow your capital without necessarily putting in additional money from outside. And the truth is that by the time your portfolio, I showed us last week, you saw the numbers of dividend that I received, but all of those dividends, I did not withdraw them. Now, last week, trading 212 on my different investment portfolio that I've gathered together, trading 212, I had about 5.20 something pounds downturn because one of the portfolio was around 210 or 201 pound, but at the close of business, it has dropped to like 195 pounds. I know some of you will see it last week that we had a portfolio that was around 201, but when the market closed last week Friday, it has moved to 9 pounds. But one thing about I was thinking is I now went to compare that drop with the dividend that I've received within the past period. I noticed that, oh, that drop is still not up to the dividend. And I went to check the overall growth of the money that was initially invested, and it was around 180 something. I said, oh, that means the portfolio is still growing. But now the market has started going back upward. So which is a good sign that, fine, for those of you that are just coming in, you can quickly buy at that spot because you are going to benefit from the loss that has happened before. I would do that in my next slide anyway. But what I want to tell us now is when you keep your dividends in your portfolio account, you are not withdrawing it out except you have an emergency. Because sometimes when there are emergencies that, oh, you needed to meet up with a certain expenses, living expenses, for example, not luxury expenses, because I told us severally that living expenses is not luxury expenses. So don't allow living expenses and luxury expenses to affect your savings and investment goal. But living expenses honestly can affect your savings and investment goal because if you don't have emergency fund, and that is another thing that I will also be explaining to us in some of our future classes, if you don't have emergency fund, an emergency fund from my financial perspective is always saying that your emergency fund must not be less than, some will even say 6 months, but they will say it shouldn't be less than your 3 month salary. So I know some of you will be asking questions about emergency fund, but just take note of it. You will be receiving future mails as to when we'll be having classes on emergency fund. So what it implies is that if your salary per month is 200,000 naira, in your emergency fund account, you must have at least 600,000 so that when there is any emergency, you can quickly jump into your emergency fund to quickly go in there and meet some needs. Some will say 6 months. I know it is like building savings, but some people also use their emergency fund to do shares and stocks in online platform like Trading 212 and Bamboo and iVest and eToro, so that they know that, okay, it's actually my emergency fund. I'm only just investing it for now so that when I need them, I can quickly jump into it to pick from it. But if it is not for living expenses, I don't advise you to spend from your investment fund. So let's take note of that. Living expenses includes expenses like rent, basic feeding, basic clothing. Burger, if you are doing eating out or you are buying burger, you are buying shawarma, all those ones are not basic feeding. They are extra. So if it is not for those ones, or you feel like I want to go and eat suya, I want to go and those ones are not basic. So ẹni tó bá ti yó ló ń jẹ suya. That's a Yoruba word for those that doesn't understand it. So it's only when you are full that you begin to eat dessert. So let's take note of that. Don't spend your dividends, reinvest it. So this strategy compounds your return, smooths out market volatility, and dramatically accelerates long-term wealth accumulation. So even if your dividend is a small amount, when you consistently reinvest it, it creates substantial value over time. I will try to share my screen for us to see soon, but let's just take it like that. So now let's look at this example that I have on the screen. Okay, Mr. Lady has his hand up. Let me finish this example, then I will ask you a question. Now, in a real world example where consider holding 2,000 worth of dividend paying ETF with a 5% annual yield. So that is going to generate £100 per year in dividends, which can automatically purchase additional ETF units. So what this one is saying is this. I have a client that we're talking, and when we're talking about investing in shares and stocks. He has a passion to invest in shares and stock, and he was thinking of, okay, I initially, my car, I wanted to buy a car. I think I did a video on that, but I've not uploaded the video. He said I think I uploaded some of it partly, but the full video is going to go into our YouTube soon. So he said he wanted to buy a car, and he's thinking of, instead of buying the car, because in UK you can buy a car on credit, and even some developed country on either lease agreement or hire purchase, and you pay back every month. So his thought was like, okay, I'm going to be paying like £200 every month or £300 every month on this car. Do you advise that I pay that £300 every month into an ETF account and continue to use public car, or just get a car that I don't need to pay monthly installments on? And like, for example, in the UK, you can use maybe £600 to just get a basic car that will move you around, but that may not be a luxurious car. And that £600, you would be driving that car. It will take you to work, you park, you move. But instead of paying £300 every month, and in 3 months, in 2 months, he has already no, 3 months, he has already gathered about £1,000 in his ETF account. And if that ETF account is giving him 5% per annum, at the end of that year, he's going to have extra £100. But if he had been using that £300, which is just 4 months, in 4 months, okay, let's say like 5 months or 6 months, he's going to raise £2,000. But if he had been using that £300 to pay the repayment for the car financing, he won't see that money again, because he has gone for interest and principal repayment, and the only thing he will be seeing is a car, and that car will have been depreciating in value, whereby the ETF he has invested in has appreciated in value. So these are little understandings that we all have to have about accumulating your fund, whether in a high interest yielding account like ISA or thereabout, or even in shares and equity. However, you can also lose your money, like I kept saying. So you have to trade it, but the possibility of losing it is not as high as the depreciation that the car could actually also bring eventually, if you want for a car. So, Mr. Lide, you have a question. You can quickly ask your question before I move on. If you are speaking, you may need to.
All right, thank you very much. Yeah, thank you, sir. So my question is around deploying back the dividends. But in the case of Nigeria, sometimes they will send some of these dividend that is maybe ridiculous. But the question I want to ask is that what's the process one can do? For instance, maybe using 1,000 naira, 2,000 naira. How can you design it? What are the procedures so that instead of returning that money to you, you can just invest, plow it back? So presently in the NGS, there's no system. So you only see the alert for the share that you are holding, and there's no opportunity to actually refer that money back, unlike what we can do on Bamboo.
Okay, okay. So I think I understand your point. Your point, to get it clear, your point is that you are not, you have not done the investment on a app to manage the investment for you. Is that correct?
Yes, for the share purchase on the through CS account on the NGS.
Okay, through the normal
So
stock account, like the one we
dividend,
did on
yes,
GTB, blah, blah, blah.
yes. So
Okay,
you receive alerts from your bank saying that this is your dividend. The question I'm now asking that what are the procedure to convert that so that to give you so that all those small dividend you can plow it back to buy for that share
okay. So this is
instead
what
of
you do.
just receiving it.
I think I have a good understanding of your question now. So to recap your question, you have bought the share, but the dividend, I can remember that sometimes like some months ago, I just received a message from GTB that they have credited me with the dividend. So this is what you can do. For those type of accounts, you don't have control over the settings and you cannot do it on your app because it's not digitized, if I get you right. So you now want to say that, okay, GTB, going forward, don't send me my shares again, don't send me my dividend again, only keep it into my account and reinvest for me. So in that instance, the first thing you need to do is identify the registrar. Then when you identify the registrar, every company has a registrar. That's the company that is in charge of the issuing of the shares and the payment of the dividends. Even sometimes you don't see GTB as the payer of that dividend. You could see the name of the registrar, as the case may be. So you can send a notification to them, that either an email or you fill a dividend reinvestment form with them and say, just don't send me dividend anymore. Reinvest my dividend back into my shares account, and they will send you the requirements, the processes that you need to go through to perfect that simple process. And if they felt that they don't want to keep their shares on a floating one, because what that implies is that you will need to buy another share with that, and if their shares is not floating, then they may not be able to do it. But if their shares is floating, what they will just do is they will use your CSCS account and they will buy another shares through a broker, and that will be added to the number of shares. But that can only be possible if the shares is delimited. If the shares is delimited, like for example, some companies don't delimit their shares except if they are on a stock exchange market, whereby you can buy 0.001. So if it is not delimited, that the minimum you can buy is one whole number, that's one shares. So if that one shares is not equal to the amount of dividends you have received, then there will be the likelihood of you not being able to buy another share. But some registrar also keeps those dividends for you, and they will be paying you a fixed income on it. And when it accumulates up to a certain portion, then they can now buy another shares for you, especially when there are new issues, or they can buy it from the open market. That's the open primary, secondary market. I don't know if that is clear for you, Mr. Lide.
Yes, sir. Thank you.
Okay. So there are primary market, there are secondary market. The primary market for shares is the one where only new issues are being sold. Then the secondary markets are where existing shares are being sold. So that your dividend will have to be used to buy another shares in a secondary market. So your registrar has to be given that instruction to take that action for you on and on and on. So that is that. So now moving on, if you reinvest your shares, your dividend, with the advent of mobile apps and the likes, that makes it easier for you to manage just at the tap of a button. But the truth about it sometimes is that some of us also prefer to work with physical brokers, people that you can see, talk to, because some people don't believe in technology. But the truth about it is, we like it or not, technology has come to stay. So, and it is the next future that we are driving into. So, like I said here, this creates a virtual cycle. Your dividend buy more shares, which generate more dividend, which buy even more shares, and that continues on and on and on. And that's a simple way to grow your wealth. And take for example, I tell people, someone was saying my investment is not really adding up too much money, as in it's still not growing as much as I expected. And I said, no, it's not for investment is actually not for present spendings, it's for future. So take, for example, if you just keep £2,000 in an ETF account, for example, and that ETF is giving you an average of 5%. The truth about it is you can be getting as much as 12%, as much as 13%. Even some can give you 20%, depending on how the company is performing. But if it is given at average of 5, which is almost the average, 2,000, if you keep it for like 10 years to come, you will just notice that your £2,000 is now about £3,200. But if you had spent that money on, maybe if you divide £2,000 by 300, so £2,000 divided by 300 is just about, even let's say 200, is about 10. So if you divide £2,000 by 200, that is, if you spend that money on 200 on something else every month, in 10 months, that money has disappeared. So you can't see it again, and you can't come across it except you earn another money. So, but if that money had actually disappeared, you spent it now actually, and it has disappeared into your trading or shares account in 10 years, where you are not remembering, you will only be remembering that when you bought that burger then or something. But in 10 years, if it has been in a share, you will now be looking at 3,200 plus. So if you even withdraw that 3,200 plus at that time, because you have made it to accumulate with your interest, your dividend, then you would be better. You can even use it to buy anything of your choice at that particular time. So let me keep moving on because of our time. So now let's look at, can you still see my screen? Okay, it's going now. So now let's look at these. This is, let's talk about downtrending stock now. This screenshot that I gave to you is one of the in my investment that I did on Nvidia. So this is Nvidia, and this is their performance last week. This is their 5 days performance, last week, Monday to today. So if you look at it, you'll notice that, yes, Nvidia actually gave me about £1 extra, if you look at it here. But their shares, if you look at the way this thing came down drastically, though it has started coming up again. But as it's coming down from this up here, is around 190.2. If you look at it, is around 190.2. And it fell down to as low as, if you look at the down here, let me see if I can get a. So if you look at the down here, I mark here, and I also marked somewhere here. This is where the stuff started before I cut the screen. So you can see it here. So it's like from £190 per shares, that's from 190.2, it fell drastically to £179 per shares. So what does that imply? About £11 had gone per shares just within a period of five days. But if somebody sell their shares, or somebody sell their shares immediately, and then they came back to buy it here, that person is going to make about £11 per shares. And if you multiply it by that number of shares that they have, it's going to give them a very huge sum of money. However, some other person is also going to be losing money per shares for that period. But if you are not a short-term trader, there is no need for panic. So what do you do? And that is what we're going to be discussing in the next slide. So if the market is coming down, turning downward, the trend is going against you, you don't need to bother. It is just like a way of testing your psychology. The truth about it is, I told you about fundamental and technical, but fundamentally, the truth is, when market is coming down, many people will begin to sell. And when you sell, because, hey, I don't want to lose more money, I don't want to lose more money, and they sell out their shares, by the time it comes backward, then you begin to now regret that, oh, if I had known, I wouldn't have sold this share. Remember, you lose some money before you sold it. Then when you later now want to buy it, you buy it at another cost, which is another loss. So what I tell people is that when the market is coming downward, that is the best time to buy at that point. When it's coming down drastically, then you now can consider buying at that point, so that when you lose when it's coming down, then you buy when it is now down, this down here, you buy, and it now starts coming up. So you are now in two positions. There is your shares, a certain percentage of your shares up there that was losing money before. Now, when it gets to the down and it started coming up, you bought additional one. You did not sell the previous one. So when it's going backward, upward, the one that you just bought will be adding money for you because that has started growing. If you buy at, take for example, you bought at 179 here. Where's my marker? So if you buy at 179 here and it grew to 181 here, so that means that one on its own has gained £5 or something. That one has gained about £4 thereabout. Meanwhile, the one that was losing money before will now begin to gain his own money back. Then at that point, you are now gaining back twice. At that point, you are gaining back your returns twice. So that takes me back to what are the things you need to do basically. Number one, don't sell out of fear. Don't sell out of fear. Many of us may begin to say, sell the shares. I remember there was a shares that there was a stock that I did, and I was showing it to my son. I asked them to actually to download an app that can emulate. It's just like a simulation of investment. So I asked them to download it and be testing investment, buying different stocks, but they don't need to put money. It's just like a not like a demo trading anyway. So, but I was now showing them a live trading as well. So they were now seeing that, oh, this thing is coming down. No, it's now 80 something. It's now they sell it, daddy, sell it, sell it, sell it. I said, no, you don't need to be panicked to sell. So don't sell out of fear. And I've told you earlier, if it is not something you can afford to lose, then don't put it in shares and stock. Don't put it in shares and stock. Because even in real life, we lose money. Businesses that we do in real life, some of them lose money. So who do you go to? You just take faith and move on. Some of us will say, I'm no longer doing this business. Some of us will say, okay, I will do it better the other way. Some of us will say, I've learned my lessons. I will not try this again. If I want to do it again, I will do it better. So you can lose money, but don't be too fearful. It's just like, okay, you have a company, you are producing a product, and you discover that the business is not doing very well as it used to do. The next thing is you say, I want to sell the company out. That is like you are selling out of fear. If the person that is buying it, I think I used to tell my team sometimes that, okay, maybe a particular vehicle is not giving us what we wanted, and we thought of, okay, let's sell it out. I used to tell them sometimes that when you sell this car out, the person that is buying it will now go and say, okay, let me put it into a good condition and then start using it. What you have sold out because you felt is giving you problem is what that person is now going to share testimony over in his church or mosque the next Sunday and said, I bought a new car. You thought it is a problem, but that person has bought it, spent extra money on it, and made it a new one, and is now using it continuously. Sometimes you even see the car and say, is it not the same car that was giving me problem? That is how it's like sometimes when you are selling your shares out of fear. So for some of you that has invested a little money last week and you see that it has dropped to like 3,000 or 4,000 or whatever, don't panic. The market that comes down will still go up, except you have made a wrong decision or the company is facing crisis. If the company is facing crisis of liquidation or bankruptcy, that is when you should now begin to be fearful. And you will definitely get to know that, oh, this company is already having that fear. So he said falling prices don't signify failure. So when the prices is falling, doesn't mean that you are failing. They present temporary discount on quality asset. So if your investment fundamental remains solid, strong ETF holdings or blue chip stocks, maintain your position, don't sell it. And that was what I said earlier. If you had made your comparisons very well and you make your decision based on is an informed decision. So don't be afraid of selling your shares out quickly because the market is down trending. Now, there is another thing that you need to do, which is called DCA, that is dollar cost averaging. You see, dollar cost averaging is similar to what I explained with us now, just not long ago, whereby I said, keep adding in more money into your stock. I said it last week. If it is 100 pounds per week or per month, add it up. If it is 5,000 naira per month, if that's what your salary can carry, add it up. So, and add it up and make it automated reinvestment. That is, as you are adding up that money into it, go and invest it again. So what that implies is that truly you are losing money from MTN shares. For example, I'll open the live app to quickly show us when I'm done with this slide, and then we can now close it soon. I have just 4 slides more, and we're going to be ending the class anytime soon. We're not going to take much time like we used to. So now, you had 100 pounds every month, and that 100 pounds is buying more shares for you of the same composition. So you are losing money in one side, but it's just like a discount because you are just not losing it totally. But by the time the market take back, because the best time to buy is when the market is in this floor. The best time to sell is when the market is at the ceiling. I used to have that at the back of my mind, but that is just if you are a short-term trader, that short-term investor. I won't say trader because we are not really trader here. I'm talking to investors because like I'm saying earlier, when we start doing this for real life investment, when we are now talking about investing into a real life business, take for example, if a photo studio or a photographer is approaching you that they want to set up a new digital world-class studio and they wanted you to invest 50 pounds, 50,000 and 5,000 pounds into it, which is about 10 million naira. You could put that 10 million there, but that person may not be making good profit at that point. The moment you put that 10 million there and you see that the person is not making good sales, is the shares value is dropping at that time, you don't need to panic and say, oh yeah, send my money back. Oh, I learned that studio photo business is no longer making money in Nigeria. Send my money back. AI is now being used for photography. But can AI go and snap people during their wedding? So these are the things that you use to quickly analyze and say, no, I don't need to panic to withdraw. Rather, at this point, let us re-strategize this business, pump in more money so that we can have an idea that would begin to earn more money for us. So dollar cost averaging is when you continue to purchase more, when you continue to put in more money into your account to buy more shares for you, even when the market is falling. So purchasing more shares at lower price reduces your average cost per shares, positioning you for accelerated gain when market inevitably recovered. So DCA transform volatility into advantage, and that is exactly what I explained to us in the last slide. I won't like to go back to it so that you won't get distracted. So that was what I explained in the last slide, where I said when you buy a new share at the floor, that new shares will begin to gain money because you just bought it. and the old share too will begin to gain more money because it has lose money before when it was coming down, and now that it's gaining coming up, is now gaining more money. So you are now gaining from two sides. I don't know how to explain it better, but when we get to question and answer session, maybe you'll be able to ask your question and I can put more clarification. So they said the third one here says focus on dividend paying assets. Dividend paying assets. So we talked about dividends earlier, and we said that is the extra money that you get from your profit, the profit of the company you've invested in the ratio of your shares with them. So if you had a company that is paying dividend, despite, like I told you, there was a dividend I received about 13 point something pounds, and I lost about £5 something because of the downturn of the market. I can just assume that it's just part of the dividend. My capital is still intact. So, but that dividend that I've kept with them, that I decided not to withdraw, is what I have lost a little bit of it. Then, when the market trades back, I get my dividend back because the market is still coming upward, and then we can just assume that nothing has happened. Like I said, I'm going to share with you my screen to see how that works in real life. The next thing says reassess your risk allocation, and that is very important. I did that as well. I went to quickly check the risk allocation, and I noticed that a lot of the companies are actually having downturn. They were really having downturn. Johnson Johnson. NVIDIA wasn't too critical because NVIDIA is an AI company, so their wave was very sharp. It come down, then it goes up. But companies like Johnson Johnson, Tesla, all those companies, their wave, it wasn't a wave. It was a serious downturn. But at that point, you can decide to check that if you are doing additional investment, you don't want to use the same ratio. That, okay, let the ratio go more to these companies that their own downturning is a wave, but not a nose diving. So nose diving is looking down and coming beam, like a plane coming down, but a wave is it goes, it comes, it waves, it comes. So you need to check again and be sure that you have not done a wrong accumulation, because if you put most of your allocations on shares that are nose diving, then it will quickly eat up your capital, and as soon as your capital is zero, you will not be able to buy additional shares, and that would not definitely mean that you've lost the whole money. So that is why it's important. Then rebalance quarterly. Sometimes you may need to go and check your pie. You check your pie and be sure that what you have combined are really performing. So if you see that they are not performing, you can just switch it, sell some of it, use it to buy some other ones just to balance your shares. And the bottom line, which is the last thing here, is maintain long-term perspective. I've said it severally. I said it earlier, and I'm still going to say it again now. Don't invest because you want the money now. Don't invest because you want the money now. I remember in 2008, when there was financial crisis, shares value dropped significantly. In fact, many students then, they were writing their research paper on the impact of the global financial crisis on the stock market of Nigerian stock or in the global stock, because it really affected a lot of companies. The same thing during the 2020 COVID. In 2020 COVID, it significantly affects a lot of companies, a lot. But the truth about it is, no government will want big blue chips company in their country to fail. Recently, Jaguar is one of the Land Rover's companies. So Jaguar had a serious cyber attack and is likely going to run Jaguar down. But the government had to intervene quickly with not small money, just because they wanted Jaguar to come back to life. So that is what responsible government does. So during COVID then, many governments were giving out, like the UK government were giving out what we call bounce back loan. They were giving out these loans to companies so that the economy can just bounce back, because they know that when private companies are failing, then the pressure will be on the government, because the largest employers of labor are the private organization. So no responsible government will want the private sector to fail. So in view of that, you just have it at the back of your mind that if companies can survive 2008 financial crisis and shares is still in the people are still buying shares, those that had shares in 2008, then the value of their shares then is not what it is now. Then 2020 also, 5 years ago, those that had issues with their shares that came down, but today it has gone upward again. And if I open the app and you see now, you will understand what exactly I'm trying to say. So what are we trying to say here is that don't invest because you want to get your immediate return now. Invest in shares and equity because you want to have a long-term shares, a long-term wealth that you are building for yourself, not just immediate wealth building. So if you are either investing in a blue chip company like the ones that we'll be showing you, or you are investing in those companies that we will be incubating very soon, please do not how do I call it? Do not invest with a mindset of short-term earnings. Take for example, I'm using this company because it's one of the company that I'm looking forward to invest in, and I will be looking at all other people that want to invest in this company alongside myself. This company, they are like all the easy mex that I said earlier. They are doing a lot of things that is having to do with emergency car rescue in Nigeria, and it's something that is not really common. It's a very risky unit that people will not want to put their money in. So if I'm going to be investing in such a company, for example, and I'm giving them equity funding to go and get their solution to market, I should not be looking at me making profit from this company, or the company should start sharing dividends in the next 3 years, not the next 4 years, even not the next 5 years. But the truth about it is that as the company is gaining traction, the value of the shares continue, the value of the company continue to increase. So if, for example, an investor had 10% investment into the present value of that company, maybe the company is worth 10 million, and this is how it's been ascertained. If you ask the founder, how much do you need to get this product to market? And they said 10 million. And I said, okay, no problem. I'm going to give you 10% of these, or I'm going to give you 5 million, and you give me 50% ownership. And they said, no problem, give us. We will go and look for the remaining 5%, with the remaining 5 million, which is additional 50%. That means I have owned 50% of 10 million. Then if by next 5 years, I didn't get any profit from them actually, but their product is in market, they are getting good traction, people are investing in, people are using their app, and they had 100,000 users. They have now migrated to Ghana. They have now gone to Kenya. The company is now worth $5 billion. Mind you, I still own 50% of the worth of that company. So my 5 million that I gave to them when they were worth 10 million then will now make me to own 50%, which is still the same value that I owned back then. So these are things that happens to you when you invest in equity, because you are not likely going to lose the whole of your money. As the company is growing in value, your percentage ownership remains the same, but your value as a owner continues to also grow along. So what are the action points for us today? Success in investing stems from consistency, discipline, and systematic execution. So what we are saying here is that be consistent. If you know that you want to be putting 5,000 into your app to reinvest and reinvest and reinvest, be consistent with it. As we have been consistent in this class, every weekend, Sunday, 8 o'clock Nigerian time, 7 o'clock UK time, we are all here gathered, incubating ourselves with knowledge that will make our future to be secured. So be consistent. Then this action plan that you should do is, number one, track your portfolio. Don't just assume that things will get better. Don't worry. Always check and look at, why is this guy just coming down for 2 weeks, for 3 weeks? They are just coming down. At that point, begin to go back to the drawing board. Go and be checking. the news, go to ChatGPT and type, why is Tesla going down every day? Why is Toyota going down every day? Go and ask questions, because something significant might be happening. Maybe it is a serious crisis or whatever. At that point, switch. You can just switch your investment from them to another company. Then reinvest dividend. We have said it severally. That's the next strategy, because that keeps to guide you. So if your dividend is coming, let it buy another share. So that share is at different price, and it makes your average capital, average equity to be balanced. It's not just that you bought the shares at £50 per shares and that is all. So if it's going up, you make money. If it's coming down, you lose money. But if you buy a share at £50 per share, at another time £40 per share, another time £30 per share, another one 55. So at any wave that the movement is moving, you are just smiling, because you are in all those areas. You have bought shares at different prices, and that's what makes your averaging balanced. Then finally, continue learning. I've talked about this, add regular contribution, like you should keep adding money, whether weekly or whatever. Then this next one says continue learning. Attend FinREMIT educational sessions like this. Read market analysis, like I told you earlier. Go to ChatGPT. If you don't have time to attend this our session, don't bother yourself. The truth about it is, this class is to build some wealth later, but we are preparing you ahead of those wealth that we want to build later. And that was why I kept saying this. So those that are smart investors will understand where I'm actually going. So, but for some of you that just want to be basic, you can still continue to attend our classes and see, okay, what is new? What are they saying? What should I do now? And the likes. You can do more of Googling or whatever, AI charts, and try to expand your investment knowledge. So let's see what are the key takeaways. Let me just finish my presentation, then I can go and do demonstration once and for all. So I think I've explained this, so I don't need to repeat myself again. So just remember that successful investing is not about making perfect decision. It's about making consistent, rational decision based on sound principle rather than emotional reaction. So don't just let it be like, hey, money is going, no, it's about monitoring it and make sure the decision you are taking is informed decision. The strategies covers today have weathered countless market cycle, economic crisis, and period of uncertainty. So just continue to monitor your business, monitor your portfolio, and you are good to go. So the final thought that I have for you all is, for those of you that has checked the market last week and you felt like, oh, it's coming down, a down market is not a reason to sell. It's an opportunity to buy your future wealth at a discount. So this is what I kept telling us. So now let me quickly show us a demo of what is happening in the market for real. Let's see what is happening in the market for real. Then I will come back to my presentation. So I'm going to share with us the real life market trend. So please, now at this point, you can start preparing your questions, because we are already almost closing the class. If you can see my slide, please let me know. Can you see my screen, please?
Yes, sir.
Thank you very much. Welcome, Ms. Tokwe. I never knew you were here.
Yes, sir. Thank you, sir. Yes, sir.
You're welcome. So now,
Yes.
let's see quickly. Last week, look at what happened to this portfolio. This portfolio was 201 something, 201 pounds, then 69 pence. And last week, the portfolio lost £5.67. And that is a minus 2.8% loss on the capital. Now, in 1 month, what happens? It shows that, okay, this is where the company, this portfolio actually started. If you look at it down here, it's about 120 or 118. But today is around 200. So for the whole 1 month, it is not a bad one. Let's now look at 3 months. So for 3 months, the trend has also been an uptrending. It's uptrending. Look at it. From here is 106, is going to 107, here 111, then 151, 200, 201. It gets to 201.08. Then it started coming down and now is in 195. No cost for alarm. It's just coming down. It will go up. Then in 1 year, it's always up. Then in the lifetime of this investment, it has always been upgoing. So no cause for alarm. Now, the next thing is that, can we even see what makes up these shares? You know, I told you the other time that there is the home page, and this home page shows different things that we have bought. So you can see that some of them are red, coming down. Some of them are just coming down like aeroplane that is landing. But some is wave, it's just like a wave of bird. But some is green that is ready to go up. So some are green, some are red. You can see different ones in my portfolio. But if I want to see the pie, I come to this pie chart. So when I click on this pie chart, this pie chart, for some of you that may not be seeing my cushion. So this is the pie chart, this pie chart here. I'm using the desktop version, so sorry that it may be different from what you have. So you will see the pie here. Click on it. So after you click on that pie, after you click on the pie, it will show you the different investment that makes up that 199 pounds. So you see there is one that is, okay, I have cash of £2 something here. I think some dividend has been paid that has not been invested. So I believe by Monday that will automatically reinvest itself. So now I have ISA ETF. I have explained to us last week class was ETF. So if you want to quickly go and be checking your record, what is ETF? Please go and be doing that now before I start asking questions. So now you can see that this one is still a wave, though it was coming down gradually from 29th of October. Then it is now here, but I'm still not panicking because I know that nothing is happening here yet. But however, if you look downward, you can see that I'm still getting dividends. Still on the 29th, they still send dividends. On 24th, I had about 3 dividends. On 27th, so you can see that dividends are still coming in, despite the fact that the shares is coming down. So what that is saying is that, yes, you can be actually having a downturn, but that does not mean dividend will not come in. Then it looks at the score of my pie. It's 9.4, which means it's still well balanced. One is going up, one is coming down. So it's a balanced pie. So I don't need to worry so much. But the truth about it is that sometimes if this pie is not balanced, and that is where this thing come in, if the share, pie is not balanced, then it means I need to go and reassess my portfolio and then do some things with it. I have one package that is just NVIDIA alone. So this is just the NVIDIA alone. NVIDIA was in beginning of last week, grew up to £210 per shares. NVIDIA alone. And they fell down to as low as £180. That's about £30 shortage in just a week. But now they have gone backward to 189. It's still far away from 210, but they are coming back. So those that bought the share here, when it was going back, they have started making more money from that one. And those that bought it here, they lost money up to here, but now that it's coming back, they begin to gain their money back. And if I look at it now, you will notice that in 1 week, this one lost £12.29. But if you look at 1 day, in 1 day, it has grew back by £2. So those that joined in 1 day, they had gained £2 straight away. Those that had it in 1 week, they lost £12, but 2 out of it has been regained, which will now be 10. But if you did not buy again, or maybe you didn't do automation to buy again, then you will be losing money totally. Now, if you look at this down here, for my own investment here is 27 pounds that I have on this market, and the return is 0.84. So what that implies is that despite the down and turn, I have still gained 3.18% returns, which is not a bad one. And by the time it keeps going up, I keep making more money. So I may become Oliver Twist and decide to say, let me buy more of Nvidia now because I know it's still going to go up. And I may decide to leave it as it is just to be watching. Now, this is where I was explaining to us the other time. So look at these shares, this allocation. You know, I showed you asset allocation the other time. And this is what asset allocation is trying to say. For those on TikTok, let me see if I can show you the screen. I hope you'll be able to see my screen, or if you can't, then sorry. So now, you can see that the Nvidia is green. The IGOS is pink. Deep one. This one is lighter. That means is already recovering gradually. So if you look at this, my share composition, a lot of it is now red, red, red. But if you notice last week, a lot were green, green, green. So what it implies is that I don't need to panic. Look at it. This is the composition, and look at it. Some are green, 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 red, green, green, red, green, green, green. Look at it. Green. Most of these Japan, Chinese, this thing, they are green. You can see IBM is green, Amazon green, Google Alphabet green. So Facebook is down. iShare Core 500 is green because this one combined 500 companies in the whole world. The top 500 companies, they are cumulative. Cisco is growing seriously, is high. So irrespective of those things, look at it. It's not a bad, so I don't need to worry. In fact, at this point, I can just decide to say, okay, guys, let's just invest additional little money and then we move on again. So that is just a quick one. I don't know if anyone have any question at this point before I ask my own question. Do you want me to show anything more that I have not shown? Okay, Mr. Lide, you are now becoming the class prefect, class captain, because I like the way you are asking questions. So, and let's keep it up, please. So over to you. You can have your floor while I stop sharing this screen to another screen. Can I have your floor, Mr. Lide?
Right, thank you. Thank you very much, sir, for the class. My question is around, of course, the concept of continuous reinvestment, no matter how little it is. But I want to ask that, is it from, I just watched while we are here. Fortunately, I saw a video. I was sent a video by the Bamboo, and I quickly watched it, which explained what you said. But the question I want to ask is that, uh, the process of setting it up, in the sense that, if for the dollar cost averaging, uh, it's a bit technical. So the question is, if for instance I purchase MTN for 500 and it's going down to like 400, so is he saying that if it is up to maybe 350 or 390, buy for me, and I will put money to say, okay, buy 5 for me when it is 390? So I just need a clarification around that.
Okay, I think that I get your question very well. Yes, I'm going to be sharing my Bamboo soon now. I'm already logging in, so I will show you us to see what is happening there as well. And I'm happy that Bamboo were so proactive to also share information with people so that they won't get to be panicking. Unlike the previous investment platform, whereby you don't get to get all this information from your broker. They are doing everything for you at the background. So now the point is this: the dollar averaging is not something that you need to do yourself. You don't need to give yourself some headache of these technical terminologies. I'm just making it so simple for us. That's why it may sound the way it sounds. But the basic thing is that when the market is down, nose diving, and is coming down significantly, if you are the type that keeps putting in money into your app to reinvest for you, then that is the time that you need to start buying more. It's just a simple buying more. No need to set a future trade and say when it falls. Yes, you may decide to do that. I taught us during our first class. I taught us how we can set future trade, future buying, so that I can buy for you in the future or sell for you in the future. Yes, you can do that if you don't have the time. But if you don't want to waste much time, you can just check and say, oh, this is the market is dropping now. Okay. Am I very confident that it's just a temporary market wave? Yeah, it's temporary market wave. Then let me buy more. The truth is that as you just buy more, you are already averaging your investment. You are already automatically averaging them. It's just like you being at different prices. Let me see what best I can use. Maybe when Nigerian economy was fluctuating seriously around that January, and you are into buying and selling. So, at that period, you can even see it on social media then that people were saying price today is not price tomorrow, that it was really trending somewhere. So, but if you are doing dollar averaging, what that implies is that you are buying phone. You buy iPhone 13 at 10,000 naira today. Tomorrow you told your people in the market that please I want to buy additional one. You bought that one at 1,100. You bought another one at 900. You bought another one at 800. Later again it rise. You bought another one at 850. So on your shelf, as a dealer of the mobile phone, you are selling phone. So on your shelf, you have different phones to sell, but the price tag you put, they are all iPhone 13. So you are not going to be putting tag of saying this one I bought it 9,900, then I will sell it 10,000. This one I bought it 850. No, everything you would want to put the present trending price on all of them. So despite the fact that you have bought them at different prices, you have already averaged your loss over them. Unlike you bought so many when it was very expensive, but now it's now down. So you will be afraid to say, oh, I can't sell at that price anymore. I'm already losing. But because you have bought at different prices from your supplier, you are not losing significantly. So this is what dollar averaging is really all about. That if you are the type that you reinvest money into you kept reinvesting into your shares and stocks, then you are not always going to be afraid when the market is nosediving or fluctuating, because you are almost everywhere within the waves. So as it's going up, you make money. As it's coming back, you make money, because you have different entering points that you have entered differently. So that is just, in layman term, what dollar averaging technique is just trying to say. I don't know if you get it now, Mr. Lydie. Is it clear now, Mr. Lydie? So let's quickly wrap up. Okay, so now that is all we have for you today. Don't forget to follow FinRemit on Instagram, Facebook. You can, if you are on Android, you can download the FinRemit app on Android. We are cooking a lot of things for you. If you have a business or you have a family friend that has a business in Nigeria and they are trying to raise capital for their business, you can start to tell them that this is where they should be. And if you have some idle fund and you are thinking of investing in shares and equity, this is where you should be. Is either you invest it in corporate companies, blue chips companies that you know, Dangote and the likes, or you invest it in companies that you are ready to take risk with them and say, let's build new things together. I'm ready to invest in you. So that is why you need to follow us on all our mobile, all our platforms. because we are going to be doing a lot, and we want you to be part of those lots that we're doing. So at this point, I want to open up questions and answers, but I would like people to tell us more about their experience when the market was turning downward. I will see if I can still share my bamboo screen. I will try and see. If not, then I would be happy to honor more questions. Is anyone ready to share their experience or questions and answers? This is the time we can ask now. Any question and answer? Question to answer, sorry. Any more clarification needed? Multiple participants. So does anyone want to share their experience when the market was down, nosediving this week? Okay. So now I will be using this as the last part of this class today. And as you can see on this screen, this was about 306,000 last week, if you remember, and now is 293. So this is for you to know that don't panic, even if the market is not moving in your direction. So look at all the shares that we have in our holdings. Does anyone have Access Bank shares? Does anyone have Access Bank shares? Look at what is happening. So look at what is happening here. So is anybody ready to share their thoughts? But MTN, look at what happened to MTN in 1 month. So MTN rose to as high as 50, how much is this? $520, no, 20 naira per shares. And it closed the market at 477 naira per share. So that's about 23 naira per shares gone. However, if you now rebuy this at this point, then it's a good one for you. Meanwhile, if you are a short-term trader and you bought at 480 and you sell at 520, you have made 40 naira per shares, multiplied by the number of shares that you have. And some of them, after they sell at this point and the market get down here, they buy again. But if you don't want to be a short-term trader because you are not going to likely have that time, you have some other commitments you are doing, then you can just average it. Just key in more into it, put in more at the bottom when the price is at the floor, because when it starts coming up, then you get to recover from that shock. So that is just a typical example of how it is not supposed to be worrisome when the market is not moving in your favor. However, let's now look at Treasury bill. You remember this Treasury bill that we used as an example, if you can still see my screen. So this Treasury bill is 80 days Treasury bill and is going to mature in 24 days now. Remember it was 30 something days the last time I showed us. That return that I'm supposed to get is still that 14.75% per annum. It has been agreed, it is fixed, it is certain. This is the reason why if you have a risk appetite, for a low risk appetite, you can just go and consider bonds and treasury bills, because that gives you an hedge to make you protect your investment. Is a fixed return. However, if you remember the first class, what you will get as return when you are doing when you are doing fixed income is likely not going to be the same. Sometimes in a month you can earn up to double of what you want to earn in 90 days or 80 days of a fixed income investment. But if you are a type that your risk, you don't have that appetite for high risk, you are a risk averse or risk indifference, then I tell people that, okay, you can consider bonds or gilts like in the UK. So government bonds, corporate bonds, those ones, they gave you the exact amount they are going to pay you back after a certain number of days. So no matter the market fluctuation, this one will not fluctuate. It's going to be static. It's just going to be as it is. So that is that about that. Let's see the US stocks as well. Yeah, the US stock as well is not let's see 1 week. Yeah, so the US stock actually is even doing well. So this one is doing well. We bought this last week. The ETF that we bought last week, that was 300 top 300 China company. We bought this last week and it's doing well. So this is another advantage of diversifying your portfolio into different countries, different sector, different portfolios. So when one is coming down, the other will start going up. Let's quickly check Dangote. Lafarge. You remember Lafarge that we checked initially? So let's see what Lafarge is saying now. So look at what happened to Lafarge in 1 week. Lafarge is down. So in 1 month, look at how far it was rising. That the last time I showed us about Lafarge growth, look at where it got to. But now Lafarge is here. But that does not mean, if you look at 5 years of Lafarge, is always on a uptrending growth. At this point, like I said, I want to say a big thank you to you once again. If you are on our live session, you can share the screen. If you are on our Zoom session, you can follow us on all of these handles. This is a time for you to go along with us as we are making the window open for all. But when it gets to a time, the window will be closed to some, and those people coming at that point, this session may likely not sound free anymore. And that is why you are in the investors community now, you are here at the right time. So keep watching ahead for next week, because next week's session is going to be taking us to a more interesting topic. We'll be sharing it with you. And those topics is going to look around your real life shares and pension. So because a lot of us don't take that pension seriously, so we'll be looking at pensions and then your future growth, how you can secure it. I'm also going to look at some level of income protection, but I'm not going to go deep into it, and how we can put all of that into this class. So today I want to say big thank you to you all. If we don't have any question, then I will be more than happy to say let's all have a good night rest. Thank you very much.
Thank you, sir. Good night, sir.
You're welcome. Thank you very much. I don't think we
Thank you,
have
sir.
a question. Thank you, Mr. Laide. Thank you, everyone.
Thank you. Good night.
Good night, ma. Thank you so much. Yes.
Mhm.
Thank you so much.
Well done, Tayo. Thank you, sir.